Hey everyone, welcome back to Corporate Decoder, the place where we dissect the financial wizards behind the curtain. And let me tell you, this latest SEC filing from Varian Alternative Income Fund is a treasure trove of financial maneuvering. And let's just say the word alternative might be an understatement for what they're up to. Don't forget to smash that subscribe button and join our Discord community linked below. So what exactly is this Variant Alternative Income Fund anyway? Think of them as a closed-end management investment company. That's a fancy way of saying they pull money from investors like you and me to invest in a wide range of things. And they operate as an interval fund. That sounds complicated, but it basically means they offer a limited way for investors to get their money back, not on demand like a regular bank account, but through scheduled repurchase offers. They're currently offering just one type of share called institutional class shares. This is a big deal because typically these types of funds require a hefty initial investment, like $1 million minimum. But good news for us, they say they might accept smaller investments at their discretion. Now let's talk about their main goal. They want to provide a lot of current income. Capital appreciation or growing the investment is a secondary goal. So they're really focused on generating income for their investors. And how do they plan to make this income? By investing most of their money in alternative income generating investments. These are not your typical stocks and bonds. They are usually private investments, domestic and foreign, outside the usual public markets. Think specialty finance, relocation, finance, real estate, debt, and other less common avenues. Now for a little dose of reality. They are very clear that these shares are not easy to sell. You can't just sell them on a stock market. You have to rely on their repurchase program, which only allows a small portion to be bought back each quarter. So if you need your money quickly, this is probably not the place to put it. All right, let's dive into the numbers. These are the most important parts, if you ask me. Looking at the financial highlights for the institutional class shares for the year ended April 30, 2025, we see a net asset value per share of 26.74. The total return for that year was 3.70%. This is a combination of income and changes in the value of their investments. Remember, last year it was a much healthier 9.62%. So there's a noticeable dip there. Now let's look at expenses. The total annual expenses after any fee waivers are shown to be 2.12%. That's quite a bit, and a big chunk of why that total return might not feel as high as it could be. They also talk about borrowing money or using leverage. This can boost returns, but it also significantly increases risk. They mention they can borrow up to 33.333% of their assets, or 50% of their net assets. Given the current market environment and the nature of their investments, this leverage could magnify losses if things go south. They've adjusted past performance to reflect their current expenses, which is good to see. But of course, they remind everyone that past performance doesn't guarantee future results. And in this case, seeing that drop in total return, we can see why that warning is so important. Now let's get into the risks, and trust me, there are a lot of them. They have general risks like limited liquidity and risks related to investing in other funds, which they call underlying funds. When they invest in these other funds, performance basically depends on how well those other funds do. They also highlight legal, tax, and regulatory risks. Laws and rules can change, and those changes can hit the fund hard. They mention new rules for derivatives, which are complex financial contracts. These changes could make their strategies more expensive or even limit what they can do. Being a non-diversified company means they can put a lot of their money into just one investment. If that one investment tanks, they could lose a huge chunk of money. It's like putting all your eggs in one basket, but a really big, really risky basket. And then there's the alternative investments risk itself. These investments are often not traded on public markets, making them hard to value and even harder to sell. It's like trying to sell a unique piece of art. You might have a buyer, but finding them and agreeing on a price can be tough. They also flag cybersecurity risk. This is huge today. If their systems or the systems of their partners get hacked, they could lose sensitive data or even their operational capacity. Then there are the conflicts of interest. This is where the investment manager might have interests that don't perfectly align with the fund's interests. For instance, they might get paid more by managing other funds that are similar to this one, which could incentivize them to take on certain risks for this fund. They've got an SEC exemption to co-invest alongside other managed funds, making sure everything is fair, but it does add a layer of complexity to watch. Let's quickly touch on who's running the show. They have a board of trustees and officers. A majority of the trustees are independent, meaning they don't work for the investment manager. They get paid a pretty good chunk of change too. The independent trustees get retainers and meeting fees. The investment manager is Variant Investments LLC. They've got a good chunk of assets under their belt, around $2.867 billion as of August. The people in charge are Curtis Fintel, Robert Elsasser, and JB Hayes. Looking at the fees for the fiscal year ended April 30, 2025, they paid the investment manager over $28 million in management fees. Interesting thing, they show 0 in waivers and 0 in reimbursements, meaning they paid the full fee without any reductions. And for the portfolio managers, the ones making the day-to-day investment decisions, they manage other accounts too. There are 2 registered investment companies and 0 other pooled investment vehicles or other accounts for each of them. The total assets for these managed accounts are around $2.923 billion. Again, no accounts managed with advisory fees based on performance, which could be a good or bad thing depending on how you look at it. The fund complex itself is quite large, with 27 funds in total as of April. This includes names like Agility, Multi-Asset Income Fund, First Trust, Private Credit Fund, and Variant Alternative Lending Fund. It's important to remember that the fund itself picks up the tab for most of its expenses. This includes offering costs, administrative fees, custodian fees, and all sorts of professional fees. This is why understanding the expense ratio is crucial. Quick heads up on those fees again. For the fiscal year ending April 30, 2025, the fund paid over $28.5 million in management fees and still 0 in waivers or reimbursements. Seems like they're not reducing those fees. Now for the legal stuff, they have an agreement and declaration of trust, and it clearly states that trustees and officers won't be personally liable for anything as long as they don't act with willful misfeasance, bad faith, gross negligence, or reckless disregard. This is pretty standard boilerplate for these kinds of filings protecting the individuals involved. And finally, the signatures. Robert Elsasser, the president and principal executive officer, has signed off on this. Curtis Fintel, the treasurer, also signs, and the trustees have all given their sign of approval too. So what's my take on the Variant Alternative Income Fund? They're operating in a complex space with alternative investments and an interval fund structure. Their objective is clear income generation, and they rely heavily on their investment manager. The numbers show a mixed bag. The total return has declined and expenses are on the higher side. The risks they mention are substantial, particularly around liquidity and investment strategy. If you're an investor looking for steady income and you can tolerate a high degree of risk and you don't need big something to consider, but you absolutely need to do your homework, understand all the risks, and ideally talk to a financial advisor. It's not a simple investment. Alright, that's our deep dive into the Variant Alternative Income Fund's latest filing. What are your thoughts on these alternative investments and the fund strategy? Let me know in the comments below. If you found this breakdown helpful, give this video a thumbs up and make sure to subscribe for more corporate disclosures decoded. And don't forget to join our Discord community linked in the description for more exclusive content and discussions. Thanks for watching, and we'll see you in the next episode of All Pro Decoder.